This is a brief lecture on Chapter 6, Interest Rates for Fundamentals of Financial Management. When we're talking about interest rates, what we are looking at are the different components which create these values, and so we need to understand cost of money, interest rate levels, determinants of interest rates, term structure and yield curves, and then also using yield curves to estimate future potential interest rates. So the cost of money is dependent upon several factors, but at the end of the day, it really is a supply and demand. If there is a lot of production opportunities, there would be a greater demand for financing and for money, and so we would see interest rates increase. There are time preferences for money. If people are saving more, there's more funds available to be lent out for greater supply and maybe not as great demand, and so we would see interest rates fall. Also, risk relative to a business, industry, or the overall economy would affect that, and then also future inflation. When we're talking about interest rates, we are usually referring to what we call the nominal rate. In this textbook, nominal rates are referred to as lowercase r, and that is to differentiate it from a real risk-free rate, which is r star. Now, it should be noted that a real risk-free rate is actually theoretical, and so this is something that economists will disagree on, but we do agree that there is some interest rate which is free from all of the other risk factors. For a lot of financial formulas, we use a proxy for a risk-free rate, which is Treasury securities, but I'll talk about why it's a proxy versus a true number here in just a moment. So when we're talking about the determinants of interest rates, this is really one of the most important principles, factors from this chapter, where we see that R, the nominal rate, is a function of a variety of terms and concepts. So we see that R, which is the required return, is the function, first of all, of R star, the risk-free, true, real risk-free rate. And then the first premium we would add to it is an inflation premium. And so for Treasury securities are subject to inflation. Therefore, the Treasury security would be R star plus the inflation premium. Then for other financial debt securities, we would see other premiums attached, the default premium, the liquidity premium, and the maturity premium. So putting this into context of looking at interest rates or yields for multiple years into a single picture, we have what we call the yield curve. What we see here is an upward sloping curve which has an inflection point which moves from increasing at an increasing rate to increasing at a decreasing rate. This is from March of 2017, and this is what we want our yield curve to look like. There are some yield curves where the longer term or the yields to maturity further out is lower than the short term. This is a leading indicator of a recession, and we definitely do not want that. So how do we actually calculate this yield curve? Well, first we start with inflation. We need to understand the historic average of inflation and then also the expectation of it moving forward. And so we see here in this example, inflation is expected to be 5% in the current year, 6% in the following year, 8% thereafter. Obviously, these are very high rates compared to what inflation is now, but there was a time in the 1970s where these numbers were actually pretty accurate. Because of this allows us to identify that inflation premium, which is important to understand the overall structure of interest rates. The next factor for the yield curve is that maturity risk. And maturity risk says that as debt instruments take longer to mature, there is greater risk, because what we would say is that 20 years from now is much less certain than 1 year from now. Now, in the current economic environment, we may test that assumption, but if we use just generalized assumptions overall, we would say that this would be true. So what we would end up doing is actually creating a rate which is R-SAR plus the inflation premium plus the maturity premium, and this would help us identify that curve. And so what we would see here is that upward sloping curve, the real risk-free rate becomes that baseline, and then the inflation premium plus the maturity risk premium adds to it. And since inflation can be higher in future years, we would see an increasing curve there. Same thing with maturity risk. So putting this in the context of debt securities that we would see in the marketplace, we see three trend lines. All of these trend lines are upward sloping to the right, which is what we want to see. The bottom line, which hopefully appears orange to you, is the Treasury bond. And so the Treasury bond, what we would see embedded in here, there would be the real risk-free rate. We would also have inflation premium, but we would not have a liquidity premium because Treasury bonds are the most liquid bonds. There is always a market for those. Default, we would say that the U.S. government they have never defaulted on loans, and so we would expect them never to default. And then also maturity premium, because there is none of the other risks other than inflation, we may even say that maturity risk premium is not embedded in here. So this is just an inflation thing. AA and triple B bonds, these are both investment grade bonds, they would have the extra risk premiums involved. So we would see some potential liquidity issues. We would see some default issues because triple B is more likely to default than AA. Also related to maturity. Now, because of this, there's a variety of theories. One of those theories is the pure expectations theory. And the pure expectation theory says that the shape of the yield curve depends on the expectations. It's probably a key signal word when you have pure expectations theory, but the expectations of investors for future rates. If interest rates are expected to increase, we would expect long-term rates to be higher than short-term rates. Several assumptions that are embedded in this theory. Pure expectations assumes that maturity risk for Treasury securities is zero. That long-term rates are an average of short-term and medium-term rates. With that, we could do some experiments of looking at rates. And so we see here that we have a maturity yield table, which we could graph into a curve. And so we see that the yield is increasing. And so if this was for Treasury rates, we would say, well, is the only thing that's affecting that inflation? So if inflation is different, then pure expectations doesn't hold. But if maturity risk is not there and it's just an issue of inflation, we would expect that to be the case. One thing that we do want to be aware of, there are macroeconomic forces in play that affect interest rates. One of these is the Federal Reserve. Since the 1970s, the Federal Reserve has had a dual mandate, which the primary mandate was price control, keep inflation low, but also full employment is their secondary or dual mandate. This does affect interest rates, and the Federal Open Market Committee is the committee which sets some significant rate policies. As the federal government continues to run deficits, they borrow more and more money, which means that there is more and more debt out there. One of the issues that we should be aware of is the fact that if the federal government is issuing bonds, people may want to invest in those versus corporate bonds, which forces corporate interest rates to be higher than what they might otherwise be. Also, international factors. If there is other issues worldwide which would affect our desire to invest in debt securities or be able to invest in businesses through debt, that is something that we would want to consider. Also, just the overall level of business activity. This definitely affects it. Currently, with 41 million unemployed people, there is a definite decrease in business activity, which would affect the overall economy. And we would see interest rates go lower to try and incentivize businesses to get back into the swing. So this is a brief lecture over Chapter 6.